So we should tell everybody that's kind of listening to us right now that they should have a barf bag ready.
They might, dude. There's 7 things right now that are on the table, Chris, that are devastating to not just real estate investors, stock investors, right? We're talking about eliminating.
Oh, I know. I heard about that. Oh my God. Yeah, I heard about that.
So everything that you're building for your daughter, I'm building for my sons, is in jeopardy. You know, it's crazy. It's like they don't want anybody to be successful, and that's horrible. So I'm gonna take the screen real quick just to make sure I'm set up here.
Yep. And we'll get kicked off probably about 7 minutes from now. Okay. Hey, Mark, how are you? I think it's time for me to buy a new computer too. This one's getting old and it's just.
Is it? What are you running?
This is just a Dell.
Okay.
I haven't made the switch over to the Apple side. I probably could now, to be honest with you. I mean, it would all interlink with this. So I probably will do that, get a Mac for my next one. I've always been a PC guy just because when I was in Wall Street and that stuff, they didn't operate on Macs.
Yeah.
We actually weren't even allowed to have a Mac until till the very end of my career there. Then they started allowing us to use Macs, but I was so deep into PCs.
Yeah, that's nuts. That is definitely nuts. I didn't want to make the switch, but I'm telling you, in 1 year, I lost 2 computers because of viruses, and I'm not doing anything wrong. I mean, what on many websites I should have been, but you know, Jesus, these days you can click on anything, and your life is gone.
Absolutely.
So,
God, I got so much stuff. Like I can't even put content out fast enough right now with how fast things are changing. And you know, I've been working real heavily with a couple economists. I've taken just a very strong stance that, you know, like, hey, you know, in politics, they always say, you know, go with the science. Well, I'm not going science. I'm going with, you know, the past, you know, equals the future if you follow it correct. And there's no one better to really understand that than to follow some very well-known economists. And that's what I've been doing. And
yeah,
you talk about the barf bag about the taxes. Well, dude, I'm freaking scared out of my mind with what's about to happen, and there's just nothing that's going to stop it from happening.
Well, I mean, you know, they're breaking all the rules. They're, you know, you're giving away money. They're printing money. They're giving that money away.
They're trying to create inflation, because if they create inflation through printing and through MMT, modern monetary theory, printing dollars devalues our dollars, gives the government more control, and they can pay their debt back with cheaper dollars later.
Yeah,
and that's what it comes down to.
And they just busted the gold standard. I mean, that's what our dollar is based on, is that gold standard. And it's like
1971.
There you go. So it's crazy. But
it's just interesting, and there's just so much information out there. Like, you know, if you go on YouTube, you literally can get contradictory information, you know, from opinion-based, you know, videos. It's really hard to understand what's real and what's not, which is why I'm spending a lot of money now on different, you know, economists, because I don't expect their information for free. So I started paying them on a monthly basis and getting, you know, newsletters and things. And like today I got one, you know, gold may have already peaked. Either way, there's one more rally likely. And it just talks about all the patterns, and, you know, they send me all their notes and they type these up and send them over. And I mean, it's just, the scariest thing is, you know, with all this printing, it's kind of almost like everybody, we want you to look over here, but what's really going on is over here. And that's what they don't want us to see. And I'm not, folks, and I know everybody's listening. We always do this little pre-talk. I want everybody to understand, I am not talking politics. Screw politics. It doesn't matter whether Trump was in or Biden was in with what I'm talking about, because these are general cyclical patterns. Okay. It has nothing to do with politics. Well, it has a little bit to do with politics. I mean, the politics in the things we're going to talk about today will speed up and make what's about to happen a lot worse. But it wouldn't matter if Trump was in. You know, a lot of people are like, oh, if Trump, you know, was in, this wouldn't be happening. Sure would. Same damn thing would be happening. It's not about politics. It's about the history, and it's about cyclical patterns. And you see behind me, like, this is just one of the many drawings I've been doing where I've been laying over economic, you know, market patterns and different events that are trending, and then taking these market patterns right behind me, which is the current, laying it over 1926, 27, 28, and 19, trying to find similar patterns, similar situations.
Repeatable patterns. Yeah.
It's frightening. And I urge, if any of you have the time, which you probably don't, but if you really want to scare yourself, lay over what's going on now. Just look at the patterns and lay it over what happened back, go back to 1918 with the Spanish flu, because the Spanish flu and the coronavirus, like very, very similar. So lay those two over. Now you have to understand in 1918 to 1930, that was a long period of time. We're here, coronavirus. Just remember, everything today happens twice as fast as it did back then. So 1918 till, the booming 20s, and then the big crash, the Great Depression. And the Great Depression went down from 1930 to 1934, correct me if I'm wrong. And then it rebounded, and then it had another fall. It wasn't, a lot of people just think it just crashed and stayed down. It bounced back up several times, much like what you saw in March. So if you start seeing these patterns, folks, it's frightening. But then when you actually get economists, without prompting them to talk about this, and you just have them explain, what are the times now, where are we at? And then they start talking about the exact same things that I'm seeing with these patterns. Right. You get that eerie chill up your spine, and you start asking yourself, like, no, this can't be real. This can't really be what's happening. And then you just look around without the rosy colored glasses on, and you're like, shit, this is exactly what's happening.
It's almost as if it's orchestrated.
Yeah. Sundaresh said, Neil Kaskara said, yeah, so that's another economist. The Fed can essentially print infinite money. They can't they certainly can. You got to understand, a lot of people think when you say the Fed, a lot of people instantly, their mind goes to the federal government. The right. Fed, in reference of something like that, is the Federal Reserve. The Federal Reserve is the equivalent of a central bank. Essentially, that's what they want. But the Federal Reserve is a private company. A private company run by a very small handful of extremely wealthy families, just name a few: Rockefellers, Rothschilds, and I could keep going from there. You look at any big banks, they're all connected to the reserve. They have to be, because that's where their money comes from. So when you say that, can the Federal Reserve just print unlimited money? You're darn right. It's fake money. They're just fiat money. They can print as much money as they want, because now today it's just exchange of dollars. So how does the government come into that? Well, there's the Treasury. The Treasury and the Fed basically go back and forth. The Fed needs the Treasury to need money, and the Treasury needs the Fed to print money. It's a great symbiotic relationship, because the Fed just wants to print more, because that creates debt, and the debt comes over to the Treasury. The US government goes deeper in debt with the exchange of notes, essentially just like we do with a private loan. They just exchange notes, which are just debts. And when the Fed wants to, speed the economy up, slow the economy down, it gets too crazy there. They just buy debt or sell debt. They have the ability to do a lot of these monetary policies. And so you're right, they can just print money. And here's the scariest thing. You might follow Keynesian economics, or Keynesian economics, as some pronounce it, as I do too. That's kind of the old stuff. That wasn't even there's a lot of problems with that. But today we're into MMT, modern monetary theory, which basically says, if you print unlimited amounts, I'll sum it up. If you print unlimited amounts of money and you make that money go into the economy, then that will stimulate the economy. And that is not what will happen. It's just not.
So think about when we've gone to war, we tried to destabilize other countries. What do? We did money drops.
Absolutely.
Right? We flew over countries dropping money on them to destabilize their monetary system. We're doing that to ourselves now.
Absolutely.
Essentially, that's what it is.
It's by design. A lot of people are like, oh, well, the government had to do it for coronavirus. Go back to the Spanish flu. They didn't do what they're doing today. They didn't have to do that. Not at all. During the Spanish flu, yes, things were different, but it was more Austrian economics. Just kind of let the markets do what the markets do. They're free. Just let the markets be free, and that's kind of what they did, which hurts. And what the government does today is they say, oh, we don't want anyone to feel pain. We don't want anything to crash. We can just print money and fix it all. And folks, it just digs a deeper hole.
Oh yeah.
So now that everybody's bummed out, we probably lost some people, but we're at 90. We're at 91 people. Let's get into this and have some fun here. Let me just open a few things up here real quick, and then we'll go live. All right. Sorry, give me one quick second. I just don't want to hit the record button until I've got everything I need. I've got something on that screen, so I can't do that.
I think we're recording.
We are recording, son of a pup. Have we been recording this whole time?
Yeah, we have. If we disappear, everybody knows why now, right?
Well, this will be an interesting replay on the recording that we get. A lot of people are going to be like, wow, that was interesting topics that they were
The
talking
pre-shows
about.
are awesome. We should charge for the pre-shows, Chris.
I know a lot of people love the pre-shows. A lot of people show up early just for the pre-shows, which I don't blame them at all.
There you go.
All right. So let's do this. I don't have to hit record. So welcome everybody to another week of the Wealth Webinar Series. I appreciate you all being here. I appreciate each of you being here for the pre-show where we're talking about current times, economics, and all sorts of fun stuff. But what we're going to be really talking about today is a scary thing called taxes. There's two certains in life, folks. What are they? Death and taxes. Okay, death and taxes are the two certains in life. And we're going to talk about what's going on in the current environment, the current administration with the new tax laws. But we're not going to just sit here and, and I want to be very clear on being recorded right now. We are not getting political. So if anyone on here is, on the left or the right, I don't care what side you're on. Good for you. But we're not going there. We're talking about real tax. We're talking about the things that are really going to happen or proposed to happen within the new administration's tax law. Okay. This isn't a political thing. I want to be clear. I will stay away from politics. If anyone asks questions about politics, I will ignore them. Okay, because I know nothing about politics and I want to stay that way. The more neutral I stay, the better off I seem to be. And I seem to be a little bit healthier too by doing that. The other thing we're going to talk about is not just these changes and what's coming down the pipe and all this stuff and what it means for all of you. We're also going to talk about strategies. David is going to talk about extensive ways you can actually kind of play into what's happening, beat what's happening, be smart about all these things. And these are the really important things. So folks, if you don't have a pen and paper, you're going to want it for this one because this is very relevant. You guys all do know where kind of, if you own a business, this is the time when you're thinking about taxes. What can I write off? What can I not? How can I play into this? Maybe I missed it for 2020, but can I do something in 2021 to not give the government any more of my money? So these are the things we're going to do. But before we do that, I've got a little video I want to start with just to get everybody in the right mood here. So I'm just going to share my screen here really quick. Turn on the volume, share that. I got to move these out of your way. All right. You see a dark screen, David?
There you go.
All right, here we go.
Get out of here. I'm not banking with you. Not you. Not you. Nope. Nope. I'm going to be my own bank. I'm not banking with you. Uninterrupted compound interest. Start your infinite banking policy today. Bye-bye, big banks.
All right, folks, it doesn't get any better than that. The jokes just will keep on coming because my job to make you guys laugh. So yes, a shameless little advertisement before we get into this. Direct from not our sponsors because we are our sponsors, but I hope you guys enjoyed that. I hope you guys got a little laugh. I know David's laughing about that. There is not a person out there, I think, that does not like Star Wars. And that is just damn funny. So David, can you do me a favor and just tell everybody a little bit about who you are, the company you're with, and just do your bet. You could even go into the Batman thing if you want.
Oh, I skipped that last time. So
I know you did.
My name is David Van Landingham. I'm an executive corporate analyst with Nevada Corporate Headquarters. Nevada Corporate Headquarters has been around for 31 years. We have our own law firm, CPA firm. We've been in the real estate space for 31 years. And I've been with the company for just about 10 years. And I've got about 6,500 real estate investors that I work with on a daily basis on everything from structuring to estate planning to taxes and everything in between. That's important to have in your bag of tools to be successful.
Fantastic. And I'm just going to, folks, as we go through and David teaches you this very important, relevant things, I'm going to be taking a lot of notes. So if you have questions, I'm going to change it up a little bit. Please put your questions in the Q&A because I'm going to be taking a bunch of notes here and I might miss your chatted in questions. So if you have questions, use the Q&A. I'll be watching that the whole time David's going and keeping very close tabs on the questions that come in. And we'll make sure that all the Q&A questions get answered. And also before we get started, don't forget, folks, we've got this every single Wednesday after this. What do we have? We have a happy hour. Okay, we have an Ask Me Anything happy hour for a half hour. So at this happy hour at 4:30 Eastern time today, a few short hours after we're done with this training, join us for that. I'll be posting in the chat comment section. I'll be posting the links where you guys can register. There's no cost for it. All you got to do is just show up with a cocktail, and that cocktail can be nothing more than a tea or a coffee. So make sure you guys join us. If you have questions, we will it's free for all. We answer your questions as on an as-come basis, and we do that for 30 minutes. So I'll put that up. So David, take it away from there, man.
All right, beautiful. Let's share the screen here and get it going. I like that cocktail hour, Chris. That sounds fun. So when we become real estate investors, or actually a business owner in general, there's always going to be a lot of questions about the type of income that you're generating. Real estate's a perfect example because it generates more than one type of income. So we are going to talk about active income. We're going to talk about passive income, the all popular 1031 exchange, the advantages to becoming a real estate professional, and how do we do that, and what are those good bennies for that. We're going to talk about deductions because everybody wants to know about deductions. Some people walk the line, some people cross the line, so we need to know where that line is so we can make sure that we don't blur it out. And then we're going to finish up with self-directed retirement accounts, which is huge. You can take control of your money and your investments and probably do better than many of your financial advisors out there. So passive income, as I mentioned, relating to real estate, rental properties, that's simple. So if you've got rental properties and you've got 12-month leases on them, those are considered passive income. Now, I get asked all the time about Airbnbs, short-term rentals. Those are not passive income. Those are going to be active income. So we're talking long-term rentals. Stock market investments can be active or passive, both ways. Interest income, passive income can only be offset with passive losses. And we're going to talk about that because there is a way to sidestep that a little bit. Active income is derived from working, that nasty, ugly word working. So when you go to a job and you work 9 to 5, that's really active income. So if you're flipping houses, doing wholesales, working as a realtor, that's working, and you're penalized for that and taxed at a higher rate because you shouldn't be doing it. So short-term investments of all sorts, again, flipping, wholesaling, perfect example, and self-employed income, whether you're a contractor that's self-employed, whether you're a realtor that's self-employed, home inspection company, that's the category that you fall in. So passive income, real income is treated as ordinary income. State and federal taxes based on where you live could be an impact as well. So be aware of where you invest and what those state taxes can be. Some states are a little bit worse than others, and some are a lot worse than others. Rental income is not subjected to self-employment tax. So here we go. We're reducing our tax load by choosing how we want to operate, active or passive. Upon the sale of a rental property, currently we're at 15 to 20% based on your income levels, based on if you're married. So that's something to take note. We will talk about some potential adjustments to that soon. Depreciation losses, one of the most valuable deductions in real estate. Depreciation just basically goes against your purchase of a property. So if you purchase a property for $300,000, that residential property is depreciated out over 27 and a half years, which is 330 months. So you're getting back a piece of that depreciation every month, which offsets your rent. So it's really substantially reducing your taxable income at that point because that depreciation offsets that. Requires no money to be spent, yet creates cash flow via the savings. Now, this is a big one for me because a lot of people, want to talk to us about, hey, listen, I'm going to go out, I'm going to pull you into this conversation, Chris. I'm going to go out, I'm going to buy a rental property and I'm going to fix it up and then I'm going to rent it. Well, you got to be careful because a lot of people say, I'm going to buy this rental property. It's a great deal for $150,000. It needs about $50,000 in, repairs. So we have to understand something. There are two different categories of how these different types of repairs, maintenance, or improvements are going to be taxed. Are they going to be viewed as a capital improvement, which is amortized over the lifetime of the property, that 27 and a half years. So if you dump $50,000 into a rental property, don't think at the end of the tax year you're getting that 50,000 back. A lot of people go into it that way, and it's it's not a good thing. It's a shock. So use strategies. I'm going to give you one strategy. I'm going to throw it to Chris, and he's going to talk about the Burr method real quick. But if you're going to go out there and you're going to buy a property as a rental, and you're going to, fix it up, put some money into it, be aware of what you need to do to keep it something that's fully deductible that year. So if you buy a property and all the flooring needs to be replaced, and you replace all the flooring, guess what? That's going to be amortized over time. But if you do some of the flooring, that could be fully deductible that year. So if you went in and did a couple bedrooms and a hallway, those hallways are just, I don't know why anybody even allows carpet on hallways, right? So if you go in there and do a couple rooms one year, and then the next year do a couple more rooms, those are costs and expenses that can be deducted that year. If you do it all, now you're looking at, something that's amortized. So if you look at the language here under capital improvements, you'll see all versus repairing a window, some flooring, existing floor, a room, right? So there's another way to do this so you can get that money back quicker, which is called the Burr method. Chris, you want to jump in on that?
Yeah, so we've done that a lot. I mean, we started our real estate career as flippers, but very quickly realized there was a big cash drag on flipping. So we started taking some of our flips, the properties we were renovating, and then just maybe not doing everything we would if we were going to flip it, but getting it rent ready. Then what we do is after we were done doing that, we were using private money. We would take the deal to the bank, and then we would basically refinance the property. And the bank would give us 80% of the as complete appraisal because we just renovated it. We forced the appreciation up. And once we got that that loan, that 80%, that made us whole. Sometimes we put money in our pocket and then we just rented it. And the other thing we always told the bank is we told the bank we were going to rent the property out, and they love that because now they have this lease that they can attach to the mortgage as another form of, if they don't pay us, we'll just, assume the lease. So that's what we did. The Burr method, buy, rehab, rent, refinance, and then I always like to say repeat right now, is a great method for cash flow. And also it served well for us because it allowed us to get through those difficult times where maybe cash was tight and we couldn't sell a property and wait for better times and then sell the properties at a higher price, which is what we've been doing.
So you mean it's easier to refinance when you got somebody in there?
Much, much easier. The bank loves having a renter in there.
Yeah, that's the key to it. And that repeat word's the best. I mean, you just keep doing it. I work with people that do that on a constant basis, and that's exactly what they're doing. They're putting that money, they do a cash out refinance, pull their money back out. Now they've got their money that they've upgraded the place with. The place is appreciated in value. It's a win-win situation, but you got to be smart. The other option to this is buy turnkey rentals, right? Let somebody else do all the upgrading, fixing everything up, getting a tenant in place, and then you're going to get into a turnkey rental. So there's a lot of different options on the table, but you just need to know where the oopses are. So if you go out there and dump a bunch of your own money in there and you're doing more so improvements, you're not going to get back what you think you are at the end of the year. So depreciation, I love depreciation. Depreciation is a great thing because really what it is, if you think about it, I kind of use the garage sale mentality. So if you go out and spend $2,000 or $3,000 on a refrigerator, and those things are getting really expensive these days. They've got TVs, and I saw one the other day at Costco that takes a picture of the inside of your refrigerator. So if you're out shopping, you can tell what you need by what's not in there. It's kind of nuts. But if you were to buy a refrigerator for $2,000 or $3,000, what's the life expectancy of that fridge? Could be 4 years, 6 years, 10 years, who knows, right? With my luck, the refrigerator craps one day after the warranty's expired. That's really the way it kind of works. Always. So what do? We take that refrigerator, most people, and we take it and we put it out into our garage, right? We got the backup now. We got the, for the party foods and the beers and the extra milk and all that stuff, right? So that's kind of a cruel thing. So I lived in Vegas for 25 years. I'm in Florida now. I've been here almost 7 years. I can tell you this, folks. You put a refrigerator in the garage. That is death row, right? That is death row. It's hot. It's humid. It's not going to perform well. Sooner or later, that thing's just going to choke out and start dying. So it's going to go from your kitchen to the garage, and then probably to a garage sale, and it's probably going to end up at the curb or being donated or something. So that's really what depreciation is when something loses its value over a set period of time. And everything either has a set class or what we call an open class to things that haven't been named. So your 5-year property, your peripheral equipment, vehicles, things of that nature, appliances. Then you've got a 7-year catch-all for like office equipment and things that are not classified. The 15-year property, this is a class that includes roads, fences, and shrubberies, right? So if you're buying multifamilies or apartments or things like that, when you're having those shrubs put in and those fences built, they've got a lifetime that they depreciate out over as well. And then we get to the hard assets. We get to the rental properties. The rental properties, residential rental properties depreciate over 27 and a half years, like I said before, versus a commercial property at 39 years. So based upon your investments or your investment category types, single family, multifamily, commercial, there's going to be different schedules involved. But that's cash on cash coming back to you. And that's a beautiful thing. So the active income we talked about a little bit. So wholesaling, rehabbing as a business needs to be treated as such. Buying and selling a property is really inventory. That's how the IRS classifies that buying and selling short term inside of 12 months. Profits are subject to state, federal, and employment tax. I lived in Nevada. Now I'm in Florida, so there's no state tax here, so I don't have to worry about that. But you have to understand when you're operating sometimes outside of your area, if I cross over and did a deal up in Georgia, I'm subjected to tax in Georgia, even though I live here in Florida, right? So you have to be aware it's physically where nexus is, physical presence, where your boots on the ground. So when we talk about doing your wholesaling and your flipping, we want to address the advantages to being structured the right way, to reduce some of these taxes, to have a separate tax return that handles all of these expenses versus being a sole proprietor and these expenses going on your Schedule E. And eventually that Schedule E or C, depending upon the type of deductions that you have, is going to get loaded up and it could be questioned at some time. That question is in the form of an audit, which we really want to avoid. So by structuring ourselves the right way, not only are we going to save money, but we're going to probably remove ourselves a step or two back from the IRS. So this is an example of a sole proprietor versus an LLC taxed as an S Corp. Those are interchangeable. When I say S Corp or taxed as an S Corp, it's an LLC tax. It's exactly the same from a tax standpoint. So what this represents, if somebody made $100,000, whether they're a realtor or a contractor or a flipper or they're a wholesaler, this represents making $100,000 in net profit. And if you are a sole proprietor, you're subject to 15.3% in self-employment tax, okay? And that is going to be on every single dollar of that $100,000. So you see represented there, you're paying $15,300. But wait, we're not done. You're also going to pay ordinary income tax on that money at the end of the year. So it can get quite costly. So the reason that, other than asset protection, that we tell you to get the LLC with the S election is because we can control that employment side of this. So the IRS rules, and IRS rules are often extremely vague by design. When you have an S Corp, the rule is you must take a reasonable salary. Well, what's reasonable? The IRS doesn't tell us that. They will tell us, however, what is unreasonable. So if you're not taking enough money, they're gonna call you out on it. Our CPA firm says 30% of whatever you earn is reasonable. So in this depiction, we've got $100,000, same $100,000 of net profit. We are going to pay ourselves 30% of that, which is $30,000 as a W-2 income. So now really what we've done is we've reduced our exposure on that 15.3% in self-employment tax. Instead of paying $15,300 as a sole proprietor, we're only paying $4,590 in self-employment tax. So we reduced it significantly. The way I like to say it is we're saving 15.3% on 70% of your money. Now, that other side, that K1 distribution, or what's referred to as an ownership distribution, is taxed only at ordinary income. So we're doing the best of both worlds, and we can control that income component. If we need to take more W-2, say we're trying to qualify for a loan or a house or anything, or perhaps put more money into our retirement plans, we can control that. You want to pay yourself 40% of that $100,000 as W-2 income, you can do that. I know that years ago when I bought this house, I had to have a certain qualifying income. So guess what? I got a raise for 2 years because that's what they average it over for a 2-year period. And then after I got into the house, my boss, he took some of that money away and I was working for less money again, but I was being tax smart. So just in this savings, it's $10,710, not a ton of money, but this is just on 100,000, just on 100,000, plus the ancillary benefit, as I said before, of having a separate tax return to handle all of those expenses. We're going to talk about those deductions. So typical investor structure, we have two sides. We have the flipping side, which is your wholesaling and your rehabbing, which is what we just discussed. And then on the other side, we have the rentals and the passive, which is taxed differently. I'm going to say this twice. Flipping and renting are not done in the same entity. They're separate. They are separate risk mitigations. There's separate liabilities, and they're different forms of taxes. So we don't want to mix those two. So we're going to separate them. If you're flipping.
Hey, David, one other thing too I do here is I even go one step further on this. So not only do we have our LLC separated the way you're describing, but what we've done is for each property, we've gone in QuickBooks, we have different classes, but we've also gone in and created different bank accounts for each one of those properties. So we're segregating the LLCs, then we're segregating everything in QuickBooks as a class, and then we're segregating the bank accounts. So it creates just this vertical for each of your properties. So, I love that you're kind of breaking out wholesale and rental for tax purposes, but to make it even easier, class it out per property. So now each one of your properties becomes its own profit center. Sorry, I just wanted to throw that in.
And what you don't want to do there is you don't want to commingle funds. And you've addressed that right there, right? You've got a system in place that allows you to keep those expenses separately. So whether you do it by separate bank accounts or you do it by separate entries into your QuickBooks, we'll talk about the REPTs. You can separate them out by that as well.
And it's super easy, and it doesn't really cost anything to do that, but it saves your ass later.
No, it does. And if you're not a procrastinator, right, it's pretty easy to keep up with. If you just have a regular schedule of when you go in and make these changes or adjustments, or your bookkeeper person. In my case, it's my wife. She's the QuickBooks queen of the house here. So
lucky her.
Yeah, no, I married smart, man. She's got a degree in finance, man. That was good. So the only thing that's connecting these two LLCs is the revocable living trust at the bottom. And I know last time in October, we talked about the revocable living trust. They hold the membership certificates of the LLC. So it's a succession plan for graduation day, as Chris calls it. So, when that day comes, when you're no longer here physically present with us on earth in this form, your assets, you want your business assets and your personal assets and everything to be pulled into that trust to bypass probate, which is another thing that we'll talk about here in a little bit. The real estate privacy trust, just in a quick nutshell, we don't put 3 rental properties in the same LLC. If you do that, what could happen? If one is sued, the others could be also sued, right? So we separate, they're essentially land trust, if you will, Illinois land trust, which have been around for forever. We take each property and put it into its own self-contained trust. So it separates liability, separates accounting, makes it a very simple process. But everything on that rental side is passive income. Taxed as ordinary income, no self-employment tax. I get people all the time that say, well, I'm going to manage my own properties. I'm going to take a percentage of that monthly income and I'm going to push it over to my LLC taxes at S Corp. And now I'm going to get paid. Well, yes, but you just added 15.3% to that. So you might want to rethink that because that may not be the best way for you to go. By the way, we need to update the revocable living trust. Tony Schuth, the founder of Zappos. Man, what a nightmare story that is. I'll have to fill you in with that, Chris.
Yeah, I don't know that story. It doesn't sound good.
Google it. It's crazy. All right, tax brackets for 2021. So I'm just going to jump in right now, and we're going to play like we have a crystal ball that's extremely foggy. We can't really see into it, but we know some of the things that are out there. First of all, everybody's panicking because change in presidency sometimes means changes in policy, changes of directions of the country. We're not getting political. We're just being factual here. The things that are on the table right now for our year, this is 2021, are in place and they're going to stay in place throughout the year. Very Rarely has anything ever been retroactive back to the first year. So we're good right now with these tax brackets. We're good with a lot of things that are in place. However, there are going to be changes. So right now you'll see that the top end rate is 37%. This has been proposed that it's going to be moving forward in 2022 or 2023 from 37% being the top bracket to 39.6%. Now, a lot of people are going, oh, that doesn't affect me. Well, guess what? Every single one of those brackets is going to creep up a little bit. So it will impact you more than likely wherever you are in those brackets. So that's very important. The corporate tax rate, which is currently 21%, is going to go up to 28%. Okay, that's a 7-point increase. So what do you think is going to happen to the cost of goods and services of those corporations that had that 7% increase? Chris, any ideas?
I don't.
It's going to, cost and services are going to go up, right? But here's the funny thing. When it went
That was
down,
a trick. That was a trick question. Sorry, I was typing a question. I heard half of it and I'm like, I do not. But yes, of course they're going up.
yeah, it's going to go up. But see, here's the thing now. So it was higher years ago, right? And it dropped down to 21%. Did they drop prices of things? No, they didn't, right? It's kind of like this whole thing when gas prices went up, airline tickets went through the roof, right? When gas was in its abundance, they didn't drop the airline, ticket prices. So it's kind of crazy. We get stuck in that yo-yo, that corporate yo-yo where, like you said, they're trying to get you to focus over here while they're in your pocket over here. So it's kind of crazy. So as we know it right now, those are the things that are there. Other things that are being talked about being eliminated is long-term capital gains altogether. So we talked about, if you sell a rental property based on your income level, it's either going to be taxed at 15% or 20%. So if they eliminate long-term capital gains, that means that income is going to be taxed as short-term capital gains and subjected to those rates, which, as we just said, could go up as high as 39.6%. Now, I'd love to tell you this is going to get better as I go, but it's not. They're also talking about eliminating the 22% dividend tax rate as well. So boom, that goes. So when you're getting dividends on those stocks, man, that's another kick, but it keeps coming. If you're making $400,000 or more a year,
Oh, this is a doozy.
you're going to start paying the 12.3% extra in Social Security, right? So again, when they start giving away money, as we talked about in our pre-show, they start giving away money, guess what they have to do? They have to find it from somewhere. They're going to print some, but they're going to find other ways to get some. And that's a great way. These last two, I told you I was physically ill. Yeah, this is get out the barf bags. If you're a real estate investor, they're talking about eliminating the 1031 exchange. So if you've got a couple, single family residences and they're played out and you're ready to move into multifamily or buy something else, or maybe the neighborhood went downhill and you want to upgrade and you want to get something bigger and better, you're no longer, if this happens, you're no longer be able to roll that capital gains forward. So if you sell a house for, $300,000 and you're going to get taxed on the gain, whatever your adjusted basis was, anything above that, you're going to get taxed. Well, the 1031 exchange would allow you to take that capital gains, not pay it, and roll it into the next property as long as the same value, same cost or more. So that's a big one to be on the table right now. And then the one that got me most upset was this. They're talking about taking away the step up in cost basis.
I know, I heard it. That made me sick.
Oh, I tell you, I'm getting sick right now. Wouldn't be pretty. But here's the deal. So let's talk about it as it affects somebody that's going to be inheriting money, right? So my mother's got, real estate property. So let's just take one property she's got that her and my father bought many years ago for $400,000. The property is worth $1.4 million today. So if my mother passes away, or God bless, when she does pass away, she listens to these, so sorry, Mom, but when she passes away, I would get a step up in cost basis. The value of that property would get reset to $1.4 million because that's the value of the property the day that she died. If I sold that property at $1.4 million, I pay no capital gains whatsoever. That's the step up in cost basis. If they take that away, my capital gains goes from the original 400,000 to the difference of 1.4. So I'm paying capital gains on $1 million. Now, that doesn't just affect people that have a lot of money or a lot of real estate. Let's look at middle America. You've got somebody that bought a family home in 1950 for $25,000. And today that home is worth 150,000. Mom and father pass away. That house is going to now go to the kids. Hopefully that's who it's going to go to. Now they're set with that same thing. They've got to pay the difference, $125,000 in capital gains or capital gains on $125,000. So that's not just punching the rich people. It irritates me to death when I hear people go, oh, it's the rich, they can afford. It's not just the rich. Open up your eyes. It's everybody, because it's everybody that's investing or everybody that's going to inherit something that somebody else invested in. That's how it's passed down. That's generational wealth. So that's a tough one, Chris. I don't know. And
well, when that's a tough one to keep, on one side or the other or in the middle, because, that's also a false negative. They're saying, take from the rich and, and give to the, not the poor, but give to everybody else. That's a complete lie. If that was the case, then, you'd have to include all the politicians in there and actually take from them, which isn't the case, because they understand the 1041 reporting. They play very heavily into foundations and trusts. They understand the loopholes. So therefore they can say, hey, tax the rich all you want, but the rich already know how not to be taxed. So you're not taxing the rich. You know who you're taxing the heaviest? Look at these numbers. Who is that? That's middle America. That is the backbone of this country, the people that own the small businesses, the restaurants, the clothing stores, the dry cleaners. That's who's going to get hit with this, not the rich. The rich will not pay any more taxes. You already know this. Like, look around, like it's been happening this way for decades, if not hundreds of years. The wealthy don't file taxes the same way we do. They know the loopholes. They file 1041 taxes. They have trusts. They have foundations. They don't pay hardly any in taxes. I mean, you've heard Warren Buffett say, boy, I should pay more in taxes. Yeah, Warren, you should, but you won't, because the laws, the laws, you have teams that know how to beat those laws, and it's not doing anything illegal. It's just written into the law. Those aren't paid. I mean, David, are they changing anything with the 1041 tax reporting? Are they eliminating that?
As of right now, no, they're not. Which is
changing. Yeah, any of the stuff for trusts and foundations and the tax reporting on that and nonprofits?
No, not yet. Not as of yet. But so the trust taxes. So if you put something into an irrevocable trust, which is one of the ways to remove yourself from this equation from a tax standpoint and put it in an irrevocable product. If they change the top rate to 39.6, that becomes potentially the trust rate. So if you ever decide to sell something that's in an irrevocable, they make it very financially painful at 39.6% in taxes. So in California, I don't know if you're tuned to this or not, but California years ago had Proposition 13. Now they've got Proposition 19, which actually goes into effect February 16th. That's going to be affecting a lot of people because there's a step up in cost basis that could be on the table even at the state level, but a reassessment of the property value for tax purposes, property tax purposes, on the elimination of passing the property from a parent to a child. And even if it's an investment property, it's going to get reassessed as well. So there's states that are already taking a really hard line at this and doing these things. And I don't know if the federal government's just going, oh, that looks fun, let's follow along. But there's definitely a ripple effect to all this, either state level or federal level. So
is there any loopholes or anything you can do for the California investors that have LLCs? They got that $800 franchise tax for each LLC. I mean, is that you just kind of screwed if you live in California with that? Is there any way around it?
That's welcome to California. Well, the way around it is have a corporation. Corporations are not subjected to that in the same manner. It's the LLC, right? But LLC,
S Corp, C Corp.
S Corp, C Corp, yeah. But so, when you come to rental properties, you don't want an S Corp or C Corp. You want an LLC, right? So, California Franchise Tax Board is a tough one to deal with. They're pretty smart, and boy, if you cross swords with them, you will lose. Definitely, you will lose.
Here's just real quick, because it's so relevant. I got to ask Alan's question just while we're in the middle of this, and I won't, I'll save the rest of the questions till the end. But he says, I'm a sole proprietor and I get rental income only. I do not declare any of my rental income as self-employment income. Is that the correct way to do that, filing taxes?
Yeah, it's not self-employment. So remember, passive income is not working. It is investing. So that income that you have through your rental is going to be strictly passive and not subject to your self-employment tax rate of 15.3%. Being a sole proprietor can mean two things. That you're holding the property in your own name, which we know is not a good idea. because if something happens, you're on the hook for the lawsuit. Even if you've got insurance, trust me, attorneys will sue beyond what an insurance policy is. And insurance is not always there for you in the first place. So if you, get sued and there's an insurance claim and let's say, your tenant has a pit bull and it bites somebody and your insurance policy says no aggressive dog breeds, you're done. So you don't want to be a sole proprietor. You want to be a disregarded LLC, or sometimes what's referred to as a single member LLC. And your rental income or rental loss still goes on the Schedule E. So it really doesn't impact you either way, but we're adding in protection, which is really important.
Yeah, and then this is an interesting one. I think I know the answer, but you're the expert, so I'm going to ask. Don't you need a C corp on your rentals to take W-2 wages from it? I don't think that's the case, but
no, that's not the case. But
Yeah, I
why
don't
would you
think
want to? Why would you want to take income from W-2 income from your rentals? Some people would say, well, I'll answer that one myself, because some people say, well, I'm trying to get loans and I've got $20,000 a month coming in rental income, but they don't look at that when they're qualifying you for a loan. That's kind of crazy. They look at W-2 income, right?
I see. Yeah.
You're self-employed, right? With that income. Now, if you've got W-2 income, that could be a reason that you'd want to do it. But what you don't want, especially with a C corp, unless you're a non-U.S. citizen, because with C corp, remember, you're taxed on earnings. That's that 20% rate that's going to pop up to 28% possibly. But you're also taxed on distributions of that money. So you're double taxed. We always talk about, C corps are subjected to double taxation. So if you've got $1,000 a month coming in rent, you're taxed 21% on that.
Yeah.
Now, if you push that to a W-2 payroll, you're taxed again 15.3% plus the ordinary income. Tax. So not good. Would not advise it. Again, unless you're a non-U.S. resident.
Yeah, I think what she's doing is she's using the C corp to manage the LLCs, kind of like what would they call that? A laddering or?
Yeah, it's stacking.
Stacking.
But,
Yeah.
there's certain ways you stack and certain ways you don't. I can stack a hamburger 3 or 4 different ways. If I don't do it right, it's going to slide out before I eat it. So you got to be careful with stacking, because you can generate unnecessary tax returns as well as unnecessary taxes. That's a good one. All right, so let's talk about it. Tax advantages. So the IRS code 162, this is designated for business owners. So first of all, let's just get it out there when we talk about tax deductions. The IRS language, again, is vague. Here's what they say. If something is a business deduction, it must be ordinary and necessary. Now, look, what is the definition of ordinary and necessary? That could be different for everybody, right? So, if I go on a business trip, and I take an Uber, is that necessary? Is that ordinary? Yes, without a doubt. If I schedule a limousine, is that ordinary? Is that necessary? It could be argued, right? Was there any other form of transportation? Did I have to have the limousine? Was it necessary? I was by myself. Who knows? But that's the murky waters that we get into when we start talking about tax deductions. So we're going to get into that, and I've got a little gift for your attendees at the end.
Fantastic.
1031 exchange, we talked about deferring. We'll get into that a little bit more. Real estate professional, which is very important because there's certain things that you can do as a real estate professional that are going to be big time tax beneficial to you. The 179 deduction, this involves a lot of equipment things. I'm going to focus mainly on vehicles because I always get asked that. People start a company, they want to go buy a company car. So we'll talk about that for sure. And then in the 2018 Tax Act, we were gifted with the 199A deduction, qualified business deduction. It's still there. We don't know if that's on the chopping block either. I haven't heard anything about it. Have you heard anything about that one?
I have not. No.
Okay, I haven't heard anything about that one either. So let's not tell anybody it's there. So those are all important. So 162. So we allow business owners to deduct reasonable and necessary expenses. Okay. So seminars, training. So if you jump on and you get involved with Chris and any of his different seminars, weekend seminars or programs, continuing education programs, those are tax deductible, guys. Those are tax deductible. Convention, travel, I've got some asterisks by there because I have some people that should be on Amazing Race. They want to bounce all over the continents and have it paid for by the company. Let's clarify a few things when it comes to travel. If it is business related, and I'll explain that, it's possibly more than likely deductible to an extent. If you're on a family vacation and you're going to mix it a little bit with business, it's probably going to be a partial write-off of some sort. Now, I get asked this all the time, David, I'm going to fly from Colorado to Florida and go look at some rental properties. So that trip's a write-off. No, it's not. Well, what if I buy a property? Is it a write-off then? Is it a tax deduction? No, it's not. People get confused on that. What happens in that case, so if you fly from Colorado to Florida and you look at properties and you don't buy anything, that was not a business trip, technically, in the eyes of the IRS. If you fly from Colorado, you fly to Florida, and you buy a property, you're still not getting that tax deduction. How that works is the cost of that trip, your airfare, your 50% on meals, your hotel lodging, your rental car, your Ubers or whatever, those get added to the adjusted basis of the property. And you get that back over that 27 and a half years depreciation period. So it's not a true write-off. Now, if you go to Cancun and you have your annual meeting there, yes, we're going to write that off. We're going to write a portion of that off or all of that off, depending upon how long you're there and what you're doing and who you're with. Okay. So there's questions on travel. That's why we got those asterisks there. I don't want anybody to say, oh, he said I could write everything off. No, it doesn't work that way. Okay. Auto expense. So you're starting a company, don't run out and buy a new vehicle. That's crazy. You can do the infinite banking and get your vehicle that way if you wanted to.
Much better way to buy it.
Much better way to get it. But in the beginning, more than likely, look, you've got a lot of other costs, a lot of other things you should be spending money on. So we're gonna go with the GSA 58 cents per mile tracking. I recommend Mile IQ to track those miles. If you're going to go old school with the log, you can do it, but why? There's apps out there that make your life simple. So download Mile IQ, put in 58 cents per mile. You get in your car, hit start, get to your destination, hit stop. It sends a report to, in my case, my wife, and we're good to go. We've got it tracked. We've got it documented. So that's a great way to do it. Later on, you want to get into purchasing vehicles. We'll talk in a minute about the 179. Fees, marketing, management, equipment supplies, legal, professional services, NCH, those things, yes, those are tax deductions. So what I'm going to do at the end, this is, everybody needs to hang on to the end, and we don't know when that's going to be, but just hang on. At the end, I'm going to give you a number to text and a certain word, and I'm going to send you 9 pages of alphabetized deductions. It's a PDF file. It's really nice. As a business owner, you need to have this. You should have it on your phone. You should have a copy in your office. Your bookkeeper should have a copy. And when you go through that list and you see all the different things that are tax deductible, you're going to be shocked. How about this one? Bail. You got to bail out one of your guys, Chris? Tax deduction.
Did you say bail? Did you say bail out one of my guys?
Yeah, bail, as in jail. Yeah. So.
Oh, okay. One of those bailouts.
Yeah.
See, I don't even think about bailing people out of jail. I think of just like bailouts now. I'm like, who am I bailing out now? Who wasn't able to pay their bills?
So, well, I mean, look, if it's a key employee, you might want to do it, right? So Shauna's taken care of. We got her on this one. So, those are important deductions. The 1031 exchanges we talked about. This is a gift, and it really what it does is it encourages stimulation, right? It encourages entrepreneurship. It encourages people to keep growing with their investments. That's why it's such a beautiful thing, and it's horrendous that it could be on the chopping block, because as we're saying, we could be deferring all of those taxes and rolling it into the next project. So there's different rules for this. I'm just going to click to a visual because I like this. We'll bounce back to the starker. So on a 1031 exchange, so you've got rental properties and you've got a couple properties. Maybe they're not performing. Maybe the neighborhood's turning. Maybe it's just time to get out of there. And you're going to sell those properties. So you're going to sell those properties and you're going to find yourself a qualified intermediary. And a QI is a must. You must have somebody else facilitate the transaction or it does become taxable immediately. So you're going to basically identify the properties that you're going to sell. That transaction goes through your QI. Your QI is going to facilitate that and hold the money, right? And then from the day that you sell it, you have 45 days now to identify the replacement properties, right? So I'm selling 2 properties. I could buy 3. I could buy 4. I could buy 1 big one, right? I'm selling 2 residential, family residential properties, single families. I could buy a multifamily. I'm selling a piece of land. I could buy a home. So it's real estate. It's like kind for like kind. Okay? So I've got 45 days to name those, and I have to provide those to the QI. I have to give them the address and all the details, and they have to equal the same amount or more, or you get what's called a boot tax, and that's on the difference. So if you've sold your properties for $500,000 and you buy something that's $400,000, that's $100,000 boot tax. So you want to make sure you're buying something the same value or more. So once we identify the replacement properties, we put them under contract, we must close by the 180th day. Now, that's not 180 from the 45, that's from the original sale of your two properties. Right?
So what if you live in New York and title companies can't get the title done in time and they can't get it closed in 180 days? Nothing is your fault. You've identified the property, you've planned to close before the 180 days, but because of attorneys, title, and all this other nonsense that happens in this state, you can't do it.
There's no relief. No relief at all.
Good luck closing in 180 days on most deals here in New York. Sounds crazy, but
yeah, New York. No, I get it with New York. I mean, you guys were completely shut down. I had people couldn't sell anything, couldn't get to the title companies, couldn't get to the county clerk's office. It's crazy. But this is the way it is. So you have to be careful with the timing of when you do these, right? Because if you start one of these October 15th, right, it's going to carry over into the next tax year. And now it's really confusing. So this is timing. Timing meets opportunity. This is what it is. In a perfect situation, the planets line up right, it's all good. But it is a little stressful, and it can be. But it's very valuable, Chris. It's incredibly valuable.
I've done it one time.
Yeah. Oh, yeah. Well, some people are one and done. You know, it's such a stressful thing sometimes.
Oh, it's too hard to identify the property and get it closed. And that I succeeded and got hit with a big boot tax. I didn't know that was the nickname, but I definitely
that's what, because you got a swift kick in the
yeah.
So the reverse exchange are at the bottom. The Starker exchange is kind of the reverse, 1031. So if Chris sees a property and he knows a good deal's not going to stick around long, and he's like, I got to buy that. But what he's going to do is he's going to purchase it, go through the QI. And then after he purchases the home, he's got 45 days to figure out which one of his other rentals he's going to get rid of and 1031. And then he's got that 180 days still there to complete the transaction. So this allows you to purchase something quickly, right? And then not have to pay the capital gains when you sell the other two. So these are not as common. Court Christie, the owner of our company, actually did one. And it was pretty smooth for him. So knock on wood, he had good luck. But these can be a little stressful if you don't meet those deadlines. And like I said, they are solid on the deadlines. They don't care about holidays or anything else. So be aware of the time frame that you're under and the restrictions for these. Passive loss limitations. This is you've got to be careful when you are in two different types of businesses, an active business and a passive business, because you can't mix those expenses and cost and try to offset one with the other. It just doesn't work. You've got a fine little window where you can offset about 25 grand based on your income levels that you get phased out in. Again, we make too much money, we get phased out of certain things, like a Roth IRA, right? You get certain age, boom, certain financial ceiling that you hit, can't invest in them anymore. But here's a way to sidestep that. Being a real estate professional. Now, if you're a real estate investor, you're probably not, or you could be a real estate professional. Real estate professionals is a designation by the IRS. You must meet certain requirements that will allow you to be classified as a real estate professional. We'll talk about those here in just a second. But it allows you to use that depreciation losses to offset active. Now, this is where we can offset our active income with some of those losses, the passive losses. So this gets right down to dealer investor. Am I a flipper? Am I an investor, which is typically, buying rental properties? So we got a nice little workaround for that. So how you do that basically is you must be an eligible taxpayer, not eligible as limited partners, C Corps, or irrevocable trusts, because those aren't really you. You must be in the real estate business, which we assume that you should be. You're on this call. Rental properties, management, development, construction, acquisition, conversion, leasing, or a real estate broker. You would qualify or could qualify as a real estate professional. You must have more than 750. That's why we have 751 hours per year. Spousal hours count towards this. And then when it gets to property management, not that I'm saying go manage your own properties, that's a choice, but if you want to do it that way, you can. It's based on what's called material participation. Now, here's the kicker on this that a lot of people don't know. Those 750 hours property management are per property. So if you've got 10 properties, that's 7,500 hours more than to qualify. But there is a way to control that by grouping all of these together. It's called, the IRS code is 469G and G9, actually, 469G9. And that allows you to group your rental properties so that 751 hours of management, property management, spreads across all of them. It becomes a nightmare if you get rid of one or replace one or something like that, but it's a workaround and you can do this. But I will tell you, the IRS has an audit division just for real estate professionals. They have a group that goes around and make sure that once you qualify for this, you're maintaining it, and you must keep records. So this is a big gift. Now, let's go back in time. 15 minutes ago, we talked about traveling from Colorado to Florida. Okay. So if I'm active in this, not an investor, but I'm considered active now because I'm a real estate professional. If I travel Colorado to Florida to explore and look for additional properties, whether I buy one or not, that is a taxable or a tax deduction. I can deduct that trip. So now, boom, we're starting to see advantages to, reaching out and becoming this, whether you are one now and understand the importance of maintaining that, or you never thought of it or heard of it before. This is something that's worthwhile to look into. There are companies out there you can Google, how do I become a real estate professional? There's companies that assist you in this. There's some great books and website on this. Take action, go out there and look for these things, because this is a great little card up your sleeve when it comes to things. It's going to open up a lot more doors and strategies for tax planning. Depreciation 179. I love this. I love this because everybody wants to know, I got to go buy a company vehicle, right? So we're going to step away from infinite banking for a second, and we're going to talk about what the government says that you can do. This is not on the slide, so you should write it down. If you go out and purchase a vehicle between 6,000 pounds and 14,000 pounds, that's gross weight, okay? You drive the vehicle for at least 50% for business, you can get one-time accelerated depreciation of $25,000. Before, when I had the depreciation schedules up there, a vehicle typically depreciates out over 5 years, right? You take that value of that car, and each year you get back a little bit for purchasing that vehicle. I would not waste this in a startup year. I would use this in a boom year where it's going to potentially lower you into a lower tax bracket to fire off a bullet like this. If you go to your wife or your spouse and say, no, David said, go out and buy a company vehicle now, I'm not signing off on that. That's not what I'm saying. What I'm saying is, when you've got a boom year, a big year, and you need to find some additional deductions, let's do the 179 deduction so we can get that $25,000 lump sum depreciation in that same year, the same year that you put the vehicle into service. Now, that's a gift, right? 6,000 to 14,000 pounds. There is another one called bonus depreciation, 100% bonus depreciation. So if you drive that vehicle just for work, okay? Let's say you've got the biggest dually pickup truck that's out there, and it costs $90,000, right? Not your work vehicle. You drive it 100% for work. You can get 100% bonus depreciation and write off that entire amount that year that you put it into service. That's huge, guys. Because look, in some cases, as we're doing tax planning and tax strategy, and we're in the fourth quarter, you're going to be told this, not by me, but by the CPAs. You're going to be told exactly this. You're either going to have to spend money or you're going to be taxed on it. That's what it comes down to. You got to spend it or you're going to be taxed on it. Your choice, right? So that's why it's important to have somebody that's tax planning and tax strategy to sit down with you and work with you throughout the entire year. So we don't procrastinate and just wait till the fourth quarter to go, oh God, I got to do something. We want to know quarter by quarter where you're at. So as we come into that fourth quarter, we've already devised a strategy and using these bullets when needed. We don't want to waste them. We want to use them when we need them. But it's a very powerful thing. I always get asked about, everybody wants to go buy a shiny new truck. So qualified business deduction. So as I mentioned before, this came on in 2018 in the Tax Act. And what this simply does is allows you not to pay taxes on 20% of your net qualified business income. So that is a powerful tool. So if you're married and you make 200 grand a year, the deduction is simple. It's $40,000. You're not paying 40,000 or taxes on $40,000 of your money. And at that tax rate, which is 24%, the marginal rate for being married and making $200,000, that saves you $9,600 in taxes right there. So guys, when I tell you about structuring the right way and you're saving, $10,710, and here's another 9,600, it's not one big swoop that you're saving, right? It's all these little things that we're given that many people don't know about that add up and they become big deductions. Going out there and trying to write something off that's a big deduction that is questionable is dangerous. We have enough to work with here. When you see the list that I'm going to send to you at the end, it's amazing what's out there for you. If you're aware of it, if your CPA is aware of it, that's even scarier if they're not. So this is another gift. Right now, nobody said anything about this, so we don't know if it's going anywhere. We're just going to be quiet amongst our little group here, and we're not going to discuss it anymore. Self-directed retirement plans. These are great. These are awesome. These are ways to take control of your money. Listen, the last 4 years, the market's been crazy. 4.5, 5 years. Who's going to predict what's going to happen with the market? How are the markets are going to, yeah, right there.
I'll predict it.
Yeah. So what do you see, Chris? Give me your Nostradamus.
Oh, well, it's not even Nostradamus. It's just patterns, and it's just economics and economic patterns. And 2022, 2023, this shit is it's all going down. And you can basically mark my word on that and hold me accountable, because I'm pretty sure myself and all the economists that I associate with are all pretty damn correct on this one, and it's not going to be good.
Yeah, and we're not trying to be negative Nellies here. We're being very practical. What are we doing? We're getting ahead of it, right, Chris? That's the whole plan.
That's it. I mean, the whole idea is my job is to help people get ready with their money, get control of their money, and I got to kind of know what we're getting ready for, and I'll tell you, that's what we're getting ready for.
Yeah, and look, people talk about doomsday preppers, right? Well, Chris is the financial doomsday prepper. I have a lot of clients that work with, I'm not sucking up to them, but I have a lot of clients that work with them, and they are positioning themselves for exactly that. I mean, how many people woke up, back in the Black Friday, right, and lost everything, or even, 2008, 2009, or the dot-com crash, and woke up and saw, 50%, 60% of their retirement plans were gone, right? And that's still happening today. We're getting these unbelievable peaks and valleys, and people, I'm just going to ride it out. Okay.
Yeah, a lot of people, too many people think that that's not going to end. Everybody's a professional stock picker these days because, they're making money in stocks, and it's very easy in this market. I'm glad they are, but you got to know when to hold them and when to fold them. And the fold them probably is going to be about at the end of 2021. So make your money this year, because I don't know where we start running out of steam.
There you go. So controlling your retirement accounts, your self-directed IRAs, or your IRAs that you're going to self-direct now, or your 401ks. A lot of people have been furloughed, laid off during the COVID pandemic. So there's a lot of people now that have access to the retirement accounts, and they don't know what to do with it. Right? They're looking at it, they go, do I sign up with E-Trade? Do I go to Fidelity? Who do I go to? What do I use? What tools are out there for me? Self-directing is a very powerful tool, number one, because it's very inexpensive to self-direct. But more importantly, you have control. You can make moves left and right. You can invest into things beyond what are we tied to? Stocks, bonds, and mutual funds. We're investing in traditional markets. When you self-direct, real estate, become private money lenders. There's lots of different options for you. Your contributions are $6,000 to $7,000 a year in an IRA. It's not a ton of money, but that's $6,000 to $7,000. You should be maxing out everything you get: health savings plans, IRAs, 401ks, everything you have. You should be maxing out college plans. You got to be doing that too. I know, Chris, you're putting away a lot of money for your daughter.
Yeah. Not in retirement plans. I put very little. I only put money in my retirement plans when my CPA says, "Hey, Chris, you got to put money into that retirement plan, otherwise we're going to give it away." I'm like, "Damn it!"
Yep.
That means I screwed up something during the year.
Well, yeah, that's why we got to make those adjustments, right? So that you just hit it again. So you've either got to contribute that money as a tax deferred contribution, or you're going to get taxed on it if you hang on to it. So let's be smart and do that. The solo Ks, which is nothing more than a self-directed 401k, have higher contribution levels and a little bit more flexibility. You can borrow against them as well. If you are under the age of 50, you can put away $19,500 a year in tax deferred contributions. If you're 50 and above, $26,000. And then your company can match up to 25% of their net, maxing out at 38,000, excuse me, just went up 38,500. So that's 58,000 a year or 64,500 a year if you're 50 or older of money that you can put in there and then turn around and start investing it, buy real estate, become a private money lender, invest in something other than just the stock market. Don't be limited and have this field of vision when you're investing. Take control of that. Very important. Your CPA is only as good as you, what you provide to them. Let me tell you something. Good CPAs, bad CPAs, but what are we doing to help them? If you're the person, now corporate taxes are due March 15th. Personal taxes are due April 15th. If you walk into your CPA's office on March 10th and you hand them a shoebox full of receipts, how great of a job are they going to be doing for you?
Sorry.
No, that's true. You want your CPA, your tax planner, you want them spending their time tax planning and strategizing, not sorting through receipts. So don't be a procrastinator and get, a system in place, whether it's QuickBooks, whether it's Quicken, whether it's Expensify, which is another app that I've used in the past. Do something to get organized, because if you're not organized, now you're pushing that on and I'll tell you, I know some CPAs will go, no, I won't do it. I don't have time. My job is to save you money, not sit there and shuffle through receipts, which is what you should be doing. So that's a very, very important thing to do. And you're helping yourself, guys, by being organized. You're helping yourself. You're helping them help you. So it's critical. Selecting the right CPA. Avoid overly conservative or extremely sloppy CPAs. If I call my CPA and say, hey, listen, I need something from my tax return for last year, and you hear ruffling and shuffling for 20 minutes, that's not your CPA, right? You want your CPA to be organized. You want a strategist, not a bean counter. And if there's any CPAs on here, I'm not offending you, hopefully, but if you're a bean counter, which is fine, you're not a tax planner, you're not a strategist. That's the person that sits down, they're at the next level, and they're going to show you all these different methods and ways to save based on your circumstances. Forget about price. It's not about how much a CPA costs you. It's about what they do for you. And let's throw something else out there. When I do live events, Chris, I love this all the time. I love baiting people at times. I'll stand up there and I'll say, by show of hands, how many people like getting a big fat refund check? And everybody, 90% of the room raises that hand. Yeah, just like that. And then I tell them, no, because who's had your money all year long? The IRS. And how much money are they giving you? How much interest are they giving you throughout the year for the use of that money? Nothing. So you want to find a CPA that gets you in that sweet spot, right? You owe a little bit, you get a little back. You don't want those big swings unless they're tied to a financial anomaly that's particular to that year, right? But consistently, you want a sweet spot in the middle. Very important. Location of your CPAs is irrelevant. I'm sitting here in Florida, Central Florida, and my CPA is back in Vegas. All right. We do everything online, secured servers. You don't have to be in front of your CPAs. I find it an inconvenience to have to get up, get dressed, drive across town, go sit there and wait for my CPA to see me, and then spend time staring at my CPA. I don't need it. That's inefficient, right? I'm looking for efficiency. So online is a perfectly good way to get it done. Be patient. Don't rush your CPA. Give them time to do the work. If you start turning stuff in now, reasonably, your CPA should be able to get your return in by March 15th and April 15th. If your CPA comes back to you and says, hey, Chris, you got a lot of going on. You've had a lot of growth this year. A lot of circumstances have changed for you this year. I need more time. So I'm going to file a extension on both your business and your personal. Okay. That doesn't mean they're not getting to it, till September or October. That's the deadline to get that extension in. But that gives them more time to do a better job for you. Look, if you're looking just to cram this stuff down and get it done, go to H&R Block. They'll even give you an advance on it and take some of your money. But that's not smart. You want to do it in a way that you're efficient. And when you're making money, guys, you want better way to say this is your financial IQ must go up. The more money you make, your financial IQ has to go up with it. And if it doesn't, somebody on your team has to have that financial IQ. And often it's the CPA. So, if you've got a CPA that's a family member or a friend, and you outgrow them, that's another common thing.
There's
Sometimes
a
we do.
lot.
Yeah. But, hey, man, I still love you, but, I got to go here. And one thing I do love about CPAs is they're very honest for the most part. And if you get into, real estate investing and your CPA goes, yeah, man, that's not my specialty. That's good. That's a good CPA, because you don't want somebody working on this stuff that doesn't understand all the differences in these things. And, if they're a typical, W-2 personal tax person, then you want to seek out somebody, like I said, we've got CPAs that have been doing this for 31 years that understand, the real estate space. It's very important. So that's a key. Don't rush the CPAs. I mean, that's a powerful thing. Be patient. So freebies are fun. I told you I was going to give you freebies. So this is the text message. If you send the word deductions, plural, lowercase, to 31996 within about 5 seconds, hopefully, depending upon who your carrier is, you're going to get a return text with a PDF file attachment. I promise it's not a virus or a bug. And it's going to be 9 pages of alphabetized deductions. Now, our CPA firm has gone through these. These change every year. Back 4 years ago, 3 years ago, 4 years ago, entertainment came off the table, right? So there's no longer deduction for entertainment. So we are constantly updating these to make sure that these are right in line with, exactly what we do. Okay.
All right. I'm putting that in the chat right now.
Yeah, put that in the chat, and then I'm going to flip over here in case anybody has questions for us. I do free 30-minute consultations, Chris, for your people. You know that. We've done it before.
Yep. And people love that.
Yeah, for the way. Oh, yeah, we've had great turnouts on that. Be patient. I will get with you or somebody from our team. We've got an incredible team at NCH. We've got our CAD division, corporate analyst division. We've got fantastic people, guys. It's not about talking to me. We've got a great team out there. So if you text the same number, 31996, and text the word consult, that'll put you into a queue to get a consultation. If you're not the text person, you can call this dedicated line for Chris Naugle, 866-545-3281, and tell them you were webinar Wednesdays with Chris, and you want to get your 30-minute consultation. Doesn't matter if you're in real estate or if you're in something else, or you've just got some questions, or tax time's coming and you need to take action. This is the time to do it.
I want to be also clear about this, because a lot of people think, when that goes up, oh, they must do that for everybody. Folks, they don't do this for everybody. And I know Shauna was on the phone with the powers that be at NCH working on this, trying to make sure that, like, hey, when we do these trainings, whether it's the 3-day training or these wealth webinar series, that our people, all of you, our members, our family, what we call our money multiplier family, have access to a live person to ask questions. And so this isn't just anybody, folks. This is just you. So take advantage of it. I know this is a free training. We do it every week, but listen, like, this is for money school only. So don't take it for granted, please.
You got that.
Shauna will kick your ass, because she went through a lot of work trying to get this.
Yeah, we did. Hey, you've got this in the chat, right?
I did. I just put that up.
I'm going to stop the share and turn it back over to you there, Chris.
Cool. Yep. I've got, so for the free list of approved deductions, I've got that. You text deductions to 31996, and then the questions and free consultation, you guys have that. And I know a bunch of people were messaging in asking, how they get a hold of you, David, and folks, there it is. There's the numbers. If David's not available, you get, the team, and all of them are brilliant with this stuff. This is all they do.
Yeah. So you're very familiar with our team, and they're great to a man. They're fantastic. So
I've been at that ginormous conference table a couple times in my time,
overlooking the Las Vegas Strip, by the way.
Exactly. Beautiful. It's beautiful.
It is.
All right, I'm just getting through these questions because we got a lot of them. Are you ready for some questions here?
I believe I am.
All right, let me get back up to the beginning. We got 12 of them. So Eric, he's been waiting a while. He texted this one in earlier. She said, clarification, did you say that using the Burr method, depreciation could be done in one shot? So hopefully you can understand that one.
Yeah, I know. I get it. Yeah. So what we're doing is we're not taking that depreciation over 27.5 years. The way to get our money back. So, right. So if you were going to buy that property as a rental and you were going to sink a bunch of money into it, rehabbing it, you would get that cost back of that rehab over 27.5 years. The Burr method allows you to put somebody in there, finance the property to a cash out refi. That cash out refi, you should be pulling out the money that you spent on rehab, unless you went crazy on the rehab and overdid it. So yeah, you're not sidestepping depreciation. What you're doing is you're finding another method to recapture financially the money that you utilize to invest and improve that property.
All right, perfect. Next question was, Eve was saying 30% per member owner or 30% divided by all members. That was something you said earlier.
Yeah, so what we're talking about there is that distribution, right? So when that distribution comes and you make $100,000, that 30% refers to the member, right? The member, because as the owner of an LLC taxed as an S corp, you wear two hats. You wear a hat of a W-2 employee and you wear a hat of an owner. So it's a strategy. Was it Eve?
Yeah, that was Eve. Yep.
Okay, Eve. So it's a strategy, Eve. So if you're married and you and your husband have this company, the strategy may be only to pay one of you right now as a W-2 employee. In other words, you're compounding that 15.3% on two incomes, right? So there may be a startup strategy where we're just paying one of you if you're a married couple or in business together, and we're going to pay one of you the W-2. And then as the business grows, then yes, it could probably sustain, paying out two.
Great answer.
But that 30% is per, not spread across.
All right. Tex said, if I have a rental that I sell and I take all the profits to pay down my primary house, which I decide to make a rental, can I do a 1031 this way? This is a good question. I don't know the answer to that one.
Okay. So here's the typical CPA answer. It depends, right? So
that is totally the typical CPA answer. Well, that depends.
It depends. So it depends. It depends on the time frame, right? So you can't 1031 your personal residence unless you've put it in service as a rental for a period of time. So it must be a rental 2 out of 3 years to qualify for that 1031. But let's not lose sight of this. Why would you want to do this if you've got a capital gains exemption, right? So we have to look at, this is why we say depends. There's a lot of information I don't know here. Depends on the appreciation of the property. What did you pay for it originally? What is it worth now, right? Because if you're single, you get $250,000 in that capital gains relief. If you're married, you get $500,000. So it may not be, 1031 is just really, they say real estate is the best thing to get into, but it's the hardest thing to get out of, right? So why would we want to 1031 our personal residence if it would really more so qualify for the $500,000 capital gains exemption based on our circumstances? So that's a great question. That's a perfect example about what our consultation is about, where you can give us this information and we can give you a little bit more guidance on those different directions to go. As a client of NCH, that's something that we do on a daily basis.
Yeah, that's a great one. Unanimous said, I heard that Wyoming, so WY, has a Wyoming statutory trust that can be used in conjunction with the LLC or corp to manage the rental properties. Is that applicable to California residents?
Yes and no right now, because it's not February 16th. On February 16th, there's going to be a reassessment in those values. Not a huge fan of Wyoming. We do use Wyoming Limited, but it's still not as good as Nevada. If it was, we'd tell you. We'd be the first ones, so it's not. But the statutory trust in every state has the capabilities of developing and building statutory trusts, which hold ownership of LLCs or corporations. As far as mixing that into the rental as a strategy, no. I would stick with the real estate privacy trust, with the death time beneficial interest being a living trust, and the lifetime beneficial interest being the LLC, as we showed you on the chart.
I got to laugh about this. I had somebody on a call one time say to me, all these LLC entity companies, they're all in Nevada. That's why they all want to open Nevada LLCs. And I literally did one of those, palm to the forehead things going, they're in Nevada because it's a good state to be doing business in, which is why that's where they set up their LLCs. If they were in New York, they'd probably be opening LLCs in Nevada, but they're not stupid enough to have a company in New York like I am.
No. Well, the reason is because we're the registered agent in Nevada. That's why our company is based.
That's true. But I just thought it was funny the way that they put that. They thought that you were there so that there was some incentive for you to open Nevada LLCs. It wouldn't matter where you opened an LLC.
Yeah, I'm not. I'm in Florida. I'm not selling Florida LLCs. So you have to go with what's best.
All right. Sundaresh said, if the expense is under an LLC and the company reimburses me as travel expense, or if the company reimburses me as a travel expense to an employee, is that deductible? I think it may be worded a little bit wrong, but.
So if it's a qualified business trip, yeah, I mean, so if you give your employee, per diem, right? If they're traveling further than 50 miles from home, which is the designation for when per diem is issued. So if they're traveling further than 50 miles from home, yes, there's per diem that we base on the GSA rates. We go by county because you can look it up. You can Google GSA rates by county. And if you're traveling to Cook County and the GS rate for hotels is, X number of dollars per day. And I can tell you, as somebody that's traveled for 10 years now, you can look at me, I've figured out the meal system. It's pretty simple. Every place you go is different, right? Chicago, Illinois, it's $71 a day. Well, that sounds like a lot of money, but geez, if you're staying in a hotel, that's continental breakfast in some places, right? So, places in Louisiana is, $41 a day. So I'm starving. I got a bag full of snacks that you got to carry. So you've got meals, you've got lodging, you've got, travel expenses, Ubers and stuff like that. So depending upon how that is, if you're an employee of the company, that is an expense to the company, right? If you put money out and you pay for that, you're going to take your receipts back to the company and they're going to reimburse you for that. Is that a deduction for that company? Yes, it is.
Awesome. All right. Next one is, let's see here. If you have an Airbnb business and you travel to set up or to look at the property, will your travel costs be deductible? You kind of hit on that, but just kind of recap.
Yeah, but this is different now because Airbnbs are active, right? We were talking about visiting for a rental property.
Oh, that's true.
This is the difference. There's just it's a little bit of language there, right, Chris, that makes these things pop open. So if it's an active business, remember, Airbnb is active. It's short-term rentals. So that would be, if you went down to Florida, came down here, I don't know, I keep saying Florida. Come on, it's 84 today. I don't know what it is there in New York, but it's 84. It's beautiful. So if you flew down to Florida or any place and you went to look at purchasing a Airbnb vacation rental, that portion of that trip would be a write-off. And if it was just to buy a long-term rental, the answer would be no, it wouldn't be. It would have to be rolled into that adjusted basis. So great question.
That is. There's a lot of good questions here. Let's see. This was that one regarding the 751 hours. If he's renovating his own property, does that count toward the 751?
That's a great question. So that would be more of active. So yeah, I guess it could be. I mean, my question is, why would you want to renovate your own property? Hire somebody else to do that. Don't be the technician in your business. Go out and find other opportunities. But yeah, that could count if that's what you're doing. If you just did 751 hours on one property, you could get called into question on that. But if you're in the business and you had 3 or 4 projects going on and you're bouncing around, 2 or 3 different projects, I think you could probably get away with that. But if you put 751 hours in, that's a rebuild, Chris.
Are you familiar with Canadian corporations owning U.S. LLCs?
Oh yeah, we stay away from that, eh? So I had to do that.
I'm basically Canadian living in here in Buffalo, so.
Yeah, there you go. So, we have the U.S. Canadian tax treaty, right? But in Canada does not recognize LLCs. So when we're working with our Canadians, our neighbors up north, we're using our corporations instead of LLCs because they don't recognize that in the tax treaty. So in that case, if they were using an LLC, they could and would be subject to double taxation, which was the whole purpose for the tax treaty, to eliminate that for Canadians.
Cool. These next 2 questions I'll hit. Cynthia asked, any words of wisdom about crypto? Kind of off topic, but yeah, you should have bought it before Elon bought his big share. That's my words of wisdom. No, crypto is something I'm continually learning about, but my worry about crypto is the cyclical nature and the volatility in it. And I think crypto in this phase of crypto, not talking about always, I'm just talking right now. I think crypto is going to follow the general market trends. If the market trends are going up, I think crypto is going to follow that. And I think when the markets come down, like I was talking, I think crypto will follow that and come out of this little bubble. But that second phase of crypto, depending on what happens, that's going to be the determining factor of really where it goes. And that will be the dip that I buy crypto in. So hopefully that helps.
And crypto's so new. There's constantly new things coming about it now, right? NFL players have the option of being paid in cryptocurrency now. I don't know if you knew that, but
I did not.
There's other companies that are accepting, Tesla is going to start accepting, crypto for vehicles. So that is uncharted waters for a lot of things, a lot of questions. When it first came out, tax wise, it was, almost people were like treating it like the dinar. If you remember back in the, 10, 12 years ago, people were talking about that. So, the rules are ever changing for crypto, based on, how people are performing, what they're doing. I personally, I'm not in the crypto space. I've had a lot of very intelligent people talk to me about getting it, getting involved, but real estate's where I'm at.
Yeah. And I think, I think there's no question, a lot of people would argue me about this, that crypto's in a little bit of a bubble. I mean, it's been just going up like crazy. I mean, a bubble is being formed when you watch something go up just based on a tweet. That's a bubble. That means it's speculative. So you got to be very careful. But I know a lot of people. My friend Neil became a multimillionaire. He owned 30 Bitcoins. He bought them back a long time ago, sold them all at 40,000. He became a multimillionaire, and he's a young guy. So I commend everybody that has crypto, but please don't forget to know when to hold them and when to fold them. And don't think this thing's going to just keep riding up to the moon and never stop, because I can assure you'll probably be somewhat upset. Let's see. How long do you have to have a renter in the property normally to refi using the Burr method? I can take this one too. This is easy. Sure. It's really bank specific. So I will do the CPA. That depends. But it really depends on the bank. So some banks will have what's called quote unquote seasoning requirements. And that means that they will require you to own it 6 months or 12 months before they will refinance the property. My bank and many community banks do not have seasoning requirements. So call your bank, ask them, do you have a seasoning requirement for how long I have to own a property before you will refi? If they say no, game on. I mean, I literally can buy a property today, bring it to my bank tomorrow, and begin the refi process. So it's really just bank specific on that one. Let's see. And that said, I have a CPA that has not grown with me, now retired and becoming my own business owner. What difference between a CPA and what is the difference between a CPA and a fiduciary? Is that even recommended at this point?
The fiduciary, no. I mean, look, you want somebody that's staying up on time, right? You want somebody that is current with all the different tax strategies, the changes in tax law. I mean, for us and what we do at NCH, the guys in our division, it's frustrating because we learn the tax code, we learn all these things, and then boom, it changes. And we learn it, and we get caught up, and it changes again. The tax code is like a New York phone book that never omits a dead number. So it just keeps growing and growing and growing. I think it's past 70,000 plus pages now, 80,000. So yes, always side with the CPA for several different reasons. One, because in the event of an audit, that person is there to defend their work on the information you provided to them. But that's what you want. You want somebody to sign up. Enrolled agent is right around that same level where you want to be. Enrolled agent, CPA, I'm going to go with the CPA.
Yeah, I agree. All right. Candace said, I have a situation. Her husband works and we have the 1099 for a rental under him, looking into an LLC for the rental. Oh, I remember Candace said this. So she said, is that what the best setup would be where we are now? So she's basically, they got a rent. It sounds like they got a rental. There's no LLC. So husband definitely, whoever's name it's in is definitely at risk, the whole family. And is it best to set it up where we are now?
Yeah, so it's really not 1099 income, right? Because nobody's 1099, they're just collecting rent, which is mailbox money, which is great. So the way that we look at that is exactly what you said, Chris. You've been doing this long enough to know it's a liability issue. It's not really a tax issue. It's a liability issue. Are there advantages to being structured? Look, if you have rental properties, you're using Schedule E, which is on your personal 1040, right? So we're not doing anything different by structuring you, but you need the asset protection. There are two things that can make passive income suck. And in my opinion, one is trying to manage your properties yourself, right? The second or third time somebody calls you on Thanksgiving Day and says, hey, Chris, I need you to come out. I've got a turkey neck stuck in my garbage disposer. You're done, right? You're done. So managing your own properties and, putting yourself in a riskful position, not being structured, are the two disasters. So get structured. I recommend the LLC. Remember, the property is not in the LLC. The property is held by the Real Estate Privacy Trust. It only assigns beneficial interest to the LLC. So you need three pieces there to make that work. And they all work together. You've got your LLC, your real estate privacy trust, and then the death time beneficial interest holder is that revocable living trust.
And I will say, anyone that owns real estate, and you're thinking, oh, I don't know if I'll ever get sued. Look, when you own real estate, it's not a matter of if you're going to get sued. It's just when and how many times. So if you don't believe that, just keep buying real estate. And then you'll call me up and be like, remember you said that, Chris? You were right. You're darn right I was.
Yeah. In tough economic times, right?
Yeah.
Lawsuits go up. So that, be cognizant of that. This is your family legacy. This is your treasure chest. Protect it.
All right. Eve said, and this is an easy one. What is the price difference between a Nevada LLC and a Wyoming LLC? And how has Wyoming failed as a location to have it there?
So I don't want to use failed.
Yeah, I think that's a wrong word.
That's harsh. So look, every state has different rules to piercing the corporate veil, right? In Nevada, the only way to pierce the corporate veil of a Nevada LLC is if it's proven you've committed fraud, right? It's a fraudulent act. In other jurisdictions, there's multiple different ways. So piercing the corporate veil is a challenge to that corporate veil to try to set the corporate veil aside and hold you personally responsible. Well, that happened in Wyoming with a case about 4 or 5 years ago. And so now there's a little chink in the armor. And being that there's a chink in the armor, which is set precedent now, there is a pathway for other people to try to pierce the veil for the same thing. We've used Wyoming for years, and we still use it depending upon the risk mitigation of that business activity. If you're sitting at home, knitting and selling your knitting stuffed animals, you're fine. You can go with Wyoming, right? But if you're doing anything where there's risk, you need Nevada. You're going to pay more for Nevada, in my opinion. You pay for what you get. You want more protection, you're gonna pay for it.
Just to clarify, if I'm a real estate professional, a broker or a realtor, I can deduct travel expenses to go look at properties even if I don't buy it.
If you are qualified as a real estate professional, it is a business for you. It's active business. It's not an investor. That's the difference. If you're an investor, like rental properties, that's your business. Remember, you got dealer, investor classifications with the IRS. If you are an investor, you're purchasing long-term rentals, that would be a cost that gets added to the adjusted basis if you bought the property. If you're exploring and it's part of your business is to go out and look and buy property and go to different markets, then yes, that would be tax deductible.
Yeah.
No. Unfortunately, now if you're going on a 7-day cruise and you're trying to write that off because you're looking at one property, one of those days, no. A portion of that could be written off, but not all of it.
Yeah, and I get that a lot. I know a lot of realtors, and it's funny, a lot of realtors don't realize that, that's their business. So pretty much everything. I mean, from mileage to, if they work out of their home, they can write off part of their square footage as home office. I mean, they could write off the paper in their printer, the whiteout, the Post-it stamps, or Post-it notes, all of it. And a lot of them, they just don't take advantage of that because they don't know what they don't know.
They do now. Yeah. If they have my list, they do. So
there you go. So, and actually, speaking of that list, just in case some of you did not get that, I'm going to put that text up. And someone was asking on this. They said they didn't have a cell phone. Is there an email that they can email?
Yeah, they can email me personally. The email.
Let me give that to them real quick. So, what's the email?
And I've got an abbreviated one. They wouldn't let me do Batman, but I've got one that's just a short.
All right. Ready when you are.
All right. So it's D as in David, V as in Victor, A as in Apple, N as in Nancy. So dvan@ncinc.com.
So I can't remember who that was asking, but there's the email. So we got that in there. All right, back to questions regarding the Burr question from Eric. How long to get the benefit of the Burr? Say I bought the property in 2019, lived in it for 18 months, then looking to make it a rental in 2021 and planning to Burr it once renter moves in, and how would the depreciation work?
Well, the depreciation doesn't change, right? What we're doing is finding a creative way to get that money back through pulling the cash out. So when we're in the real estate business, guys, cash is a tool. Cash is a tool. So you're still going to get depreciation over 27 and a half years on that rental property. When you put it in service as a rental property, and in service, by the way, means when you make it available to rent, not when you put a tenant in there. When putting in service is when it's available to rent. You've got 27 and a half years of that depreciation. What we're talking about is, in a cash sense, being able to pull money out. So if you spent $30,000 getting that rental up to speed where you can get the rent that you want, when you do your cash out refinance, there should be a minimum of 30,000 that you could pull back out. So boom, you've got that money. So technically you're still getting the depreciation, but the Burr is allowing you to get a chunk of cash out to utilize that and leverage it for additional deals.
Awesome. All right, typing in a few. Oh, this is a good one. What's considered a long-term rental now with the new tax code? Is it 12 months or less, or what do they consider long-term?
It's 12 months in a day. That's really what it is. That's the difference between active and passive income, 12 months in a day.
All right. Now we got Larry. What's up, Larry? Haven't seen you in a little bit. Just curious, what did David say about being a client of NCH? I may not have heard that comment correctly. And I don't remember that one. I might have been.
I said it's an awesome experience. I'm a client of NCH as well.
Oh, okay. Easy one. Let's see. Brad said, curious on the thoughts about a Delaware LLC. And we get this a lot. I'm in the Midwest working on multifamily development and told that Delaware would be my best route. Haven't heard about Nevada LLC for this purpose.
Okay. So Delaware certainly has its place in the space, right?
Sure
Delaware's
does.
been around for a very long time. Delaware and Nevada are similar in a lot of ways. They both have a business court. Delaware just uses a fancy name called a chancery court, right? We have a business court. We're easy. So the difference is Delaware has laws on their books that favor large corporations. And typically in the chancery court, they have a judge sitting on that court with corporate experience, right? It's just not an everyday civil lawyer. It's a judge that has experience with corporations and corporate lawsuits and veil piercings. Nevada, we serve small to medium. So 0 to 10 million. It's crazy to sound 10 million small to medium, but that's what it is. So if you're taking a company public, doing IPO, PPMs or whatever, and you want to set up a Delaware, absolutely, we'll set you up in Delaware because that's the right place for you to be. Again, this is not about because we're in Nevada, we use Nevada. If Delaware proves better for your circumstances, that's what we're going to do. Nevada, that's that niche market, small to medium-sized business.
And I think I know this one, but you're the expert in this. Does NCH have deals for multiple LLCs and trust, irrevocable trust and tax prep? Like, is there a bundled package, that you offer money school students?
Yeah, so we do a discount for you guys, for your students. So let me just give a couple different examples. We have trust, as you know, we've gone through these before. So we have a flavor that's $24.97. For you guys, it could be as low as $17.97. So there is an advantage when you call in, by the way. Say, hey, my buddy Chris Naugle told me to call you. So we try to track marketing, but sometimes people go around different avenues. So we want to capture everybody that's a part of this. But for LLCs, there's really a lot of hard costs involved. So there's not much wiggle room for what we do there. Plus we give 12 months of coaching along with that, which is very valuable. But when you get into certain products, there may be discounts, possibly, not always. And that's not up to me. And it's, if we have a discount, it's great. If it's not, I can promise you this, just having somebody there to answer and talk to is 100% worth it. My clients, they have my cell phone number. I get calls, text messages 7 days a week. I know what it's like to be a real estate investor and not have that phone a friend option. I think it's important.
What is NCH's website? Is it just nch.com?
NCHINC.com.
Somebody was asking. Let's see. This one for the piercing the veil scenario. If you get sued, doesn't the court choose which state to sue you under if you do not live in Nevada? This is if you formed a business in Nevada.
Yeah. So that's a LLCs, corporations are portable, right? So let me ask you this question. So we're going to address Delaware and then I'll go to Nevada. So why are all the Fortune 500 businesses, why are they Delaware corporations? Some people say, oh, it's taxes. No, it's also because of the corporate veil. Are any of those businesses located in Delaware? Has anybody ever been to Delaware? Chris, you been to Delaware?
Never.
I drove through it and didn't even know I went through it. It's so small. So in Delaware, yeah. So if the same principles apply and all the Fortune 500 companies in the world are Delaware corporations, right? And it works for Delaware that if you're sued and your company is physically in California or in Washington, right? Let's talk about the Alphabets and the Apples and the Microsofts of the world. Why would that be held and heard in Delaware? It's called the Internal Affairs Doctrine. The Internal Affairs Doctrine simply states that there's a choice of law ruling, and they typically, and when I say typically, this is what it is, they typically look to the original state of incorporation as the governing body of that corporate veil. So if you're sued in one state and they try to pierce the corporate veil for, commingling of funds or doing a personal guarantee for your company, Nevada steps in and goes, whoa, 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 you can't do that. That's a Nevada entity, right? So often what happens there is a change of venue where it has to go into Nevada. Doesn't matter. You still have to follow the laws. If you have a Nevada LLC and you're in California, you have to follow California laws, right? You don't have a different set of laws. But when it comes to piercing the corporate veil, they have to go with the Nevada methods of piercing. That's why it exists. In other words, Delaware wouldn't even exist. I don't even know where it's at, just a little place on the map somewhere.
I've never been there. To be honest with you, I'm embarrassed. I couldn't even tell you where Delaware is in the country.
I drove through there one time in a cab and I'm in Delaware around here? He's like, yeah, 2 blocks back,
That's funny. All right. Alan said, one other question. As I basis before, I am a sole proprietor. I had Hal claims on 2 of my rental homes. I think he said I'd had claims on 2 of my rental homes. Can I write off the deductible cost, $5,000 combined? My CPA says I could, but I would have to declare the insurance payout as income. Seems I could. Oh yeah, seems I could write off as deductibles.
Yeah, 100%. So if you're writing it, so remember, there's give and take. You write something off, there's got to be something there. If I pay Chris, I'm deducting the money that I pay Chris for my taxes, which means Chris has to pay taxes on the money that I give him. So there's a give and take there. So if you're taking that and want to get a deduction on it, then yeah, it's going to be recorded as income.
Yeah. Share. So I'm just going to answer this one live. I live in New York and I have most of my LLCs in Nevada. So no, you do not need to live in the area where you're actually setting it up. You just need a registered agent, which the NCH is my registered agent. Yep. Candace said, how much should, this one comes up all the time. How much should I plan to set aside to have an LLC established? People think it's really expensive. It's not.
And I'm going to run this back to the tax. It's not about what it costs you. It's about what it does for you, number one. And all, LLCs are not created equal. So when you subscribe and you want to go set one up on your own or go legal Zoom, I'm just going to tell you right now, there's going to be hidden costs that you don't know about. There's going to be things that are not contained in the articles of organization, language that needs to be in the operating agreement that's not there. I've seen the standard rollout stuff. I've seen some of these other company stuff. I wouldn't use it. It's a paper mill. We're not a paper mill. So when you work with us, yes, I'm not going to say we're a premium or boutique, but there is more cost involved. Depending upon I'm not going to start throwing out prices because I don't understand your circumstances, but I can assure you this, it's worth the cost. Plus it's tax deductible to set this stuff up. If you're brand new in business, you get a $5,000 startup deduction and possibly a $5,000 organizational fee deduction. So having knowledge about the deductions, what is that value that we just had right there as far as that's can be written off? I mean, that's what we have to look at. So we're constantly showing value and doing value add, not just by the cost of the entity, but how to effectively utilize that entity and make it more profitable.
Yeah. I don't think it's expensive, but if you go on to, I don't know, what is that entity thing, LegalZoom, and look at setting up an LLC there, you're going like, wow, that's so cheap. Yeah. But you don't know what you're missing. You're missing publication, you're missing all sorts of stuff. So you'll set the LLC up, it'll be really cheap. And then you'll realize, holy crap, I did that wrong, or I didn't do this. And it's going to cost you a lot. I don't know. I've set up a bunch with NCH. I never thought it was expensive. Is it, depending on what you view as, cost is an issue in the absence of value. I mean, what is the value?
It's an investment. So let me hit 2 points real quick on this, because this is something that does come up. So what we have to look at is what is the cost of not doing it the right way? That's one thing we have to look at. The other side is, look, this is an investment into your business, right? It's a foundational investment. This is the rock foundation of your business. You want to make sure that it's set up and done right from the very beginning, because it gets expensive to change things when they're not done right. So I do understand, and I'm sensitive to the costs and everything, but I know what the value is. And we really articulate that when we show you, what we do and the difference that we can make by setting that up.
Absolutely. Does it matter if your company is an LLC or a C Corp for piercing the corporate veil if it's incorporated in Nevada?
Yeah, so in Nevada, the only way to pierce the corporate veil of an LLC is if it's proven that you've committed fraud. Corporations have other things that can happen. There are other situations that are not as solid. So an LLC is better than a corporation. So a corporation taxed as an S Corp for asset protection is not equal to an LLC taxed as an S Corp. There is a difference. And that's why exclusively we use LLCs, with the exception, like I said, of somebody that's, non-US citizen or Canadian, they're going to have a corporation.
And then this one, I don't quite understand, but we'll ask it. Explain why 3 levels. Example, state LLC, Wyoming LLC, or Wyoming Holding LLC. I don't really
They're all the same. Those are just
Yeah.
different names. So I can tell you why. So let me give an example. So if you're a flipper and you're doing rentals, okay, what I'm going to do is I'm going to tell the person that's doing the flipping for that LLC, I'm going to say, we're just going to go with BYOB Property Group. Okay. And they have rentals. Now we're going to go with BYOB Holdings Group. It's a designation. That's really all it is a designation. What you're looking at is what's on the right side of the comma, LLC or INC. That's what's important, or LP or LTD, right? So that other word, holding, really means nothing. To me, it means it's a holding company for my rentals. That's the way I look at it. It's what's to the right of the comma that makes the most importance.
Absolutely. Well, we got through all the questions. The only other thing is one person was just asking, what is the website? So I'm sending that to them, but yeah, we got them. Oh, here's one more. How is a Canadian corporation that owns US corporation taxed on active real estate?
So it's basically the tax treaty. It rolls to the U.S. tax treaty. Canadians are taxed differently because there's provincial tax, right, as well as state or what level they're at. So it depends on how they're formed in Canada, but essentially the tax treaty gives relief. So in other words, they're not paying double tax. So if the effective tax rate is 30% and they're paying 15% of that in the U.S., then they're paying 15% of that in Canada. So that's why the tax treaty is so important, because it opens up trade between our two countries. So Mexico works a little different. They haven't really gotten that together yet as far as Mexico goes. But with Canada, that was the purpose of the tax treaty, was to get Canadian money flowing in and then U.S. money flowing up to Canada as well. I have clients that are U.S. citizens that invest in Canada and vice versa. So it's really just so it doesn't, hurt you from a tax standpoint. Same thing is happening, and I'll use Canada like California. If you live in California and you have a rental property here in Florida, right, you are going to pay taxes on that rental in California as income. Now, if you live in a state like Georgia, and let's say you have 6% tax in Georgia, right, you're still taxed on the difference between the 13.85% or whatever it is right now in California. They take the 6% off, being the nice people they are, but you still have the balance of that tax due to California.
And Brad, this is going back to earlier, the 20% deduction, can that be used married filing jointly?
Yeah, so that is the 199A deduction. That's what he's referring to. So you're exempt from 20% of business income. There are always certain circumstances for phase out. So whether you file separately or married, that's something you need to look at as a strategy, again, to make sure you still qualify. Let me throw something in on that. Business services or professional services aren't allowed that. So if you're a doctor, CPA, vet, professional athlete, entertainer, performer, you can't have that deduction. That's professional services. So this is for non-professional services, which really sucks, because if you're a doctor and you're in real estate, I think your little piece of the pie in real estate should be subjected to that 20% discount. But you've eliminated yourself by being a doctor. So see, Mom, I turned out okay. I'm not a doctor.
Man, you are so good at the recall, man. It's just awesome. Jeffrey said, should LLCs, and I get this one a lot, should LLCs file separate returns? I was told that the profit and loss flow through to personal returns, filing a 1065 with associated K1s for members.
Oh, that's a great question.
I wish that one came up earlier when we had everybody on here, because this is so relevant.
Absolutely.
Jeffrey, where were you, man?
Yeah, so what they're talking about is a partnership structure. So a partnership structure is a 1065. That's the tax return that it files, a 1065 tax return. So how this works is simple. If you are flipping houses, okay, and you just have a partnership LLC, and you make $30,000 and it's a 50-50 partnership, 15,000 goes to you as a 1099 and 15,000 goes to your partner as 1099. And you're basically taxed 15.3% on every dollar. That's why we don't do it that way. So if you're in a partnership, Chris, is there any way you could just draw a little cute drawing for me real quick? 3 triangles? What? You want to do it on your board, or I don't want to mess your board?
Yeah, I'm going to do it on my board.
Okay. So draw a triangle.
Hang on, let me just turn you up here a bit.
Okay. I still got to get one of those. I have one, but it's an iPad.
Oh, these things are awesome.
Not a big boy. So if you draw a triangle and label it Partnership LLC. Okay. I didn't say a pyramid in Egypt. That's pretty big, but that's okay. Now draw 2 smaller triangles directly beneath it, side by side. Directly beneath it, side by side. Yep, one on the left, one on the right. There you go. So that's a partnership structure. So now those bottom triangles are LLCs taxed as S corps. So now what we're going to try to do is eliminate our self-employment tax to a certain extent. So now, same scenario. So above the triangle, write 30K. So we've made 30K on a rehab. And now we're going to distribute 15,000 down to those LLCs each at the bottom, 15,000 for each LLC. So now what we're going to do, what are we going to do? We're going to pay ourselves 30% of the 15,000, right, as W-2 income, which is $4,500. And that's going to be subjected to 15.3% plus ordinary income tax at the end of the year. The remaining 10,500 is a true ownership distribution, and that is only taxed at ordinary income at the end of the year. So by just doing this, you're saving 15.3% on 70% of your money, once again, all day long.
Wow.
That's the right way to do it.
You know, it's funny. I wish somebody would have shown that to me before, because my CPA is always talking about like filing as an S corp. And I'm like, how do you, I don't understand. He's like, it's easy. Like you just do this. And I'm like, I don't know. I should have just said, dude, can you just draw it?
Yeah,
certainly
do a visual. That's
that was so much easier. So, you know, that was a great way to explain that. And that made all the sense in the world. All right. Kevin said, I'm a disabled veteran in Winter Springs, Florida. I have a townhouse that's in forbearance and have to act fast. I'm presently in the VA hospital from partying hard about to be.
I'm Brady 12.
Oh, because the Tampa Bay 12
Hey,
win.
at least he's being honest, right? Right? You didn't get in a car wreck. It's because of Brady, right?
Oh my God. I was like reading this. I'm like, what is going on here? And then he's messing with us. I had an LLC in New Hampshire that expired and it was all education expense, 30,000. Now I'm told I can go back to work and I have to act fast. I am in school for cybersecurity. I haven't paid my mortgage in a year. I don't want a quick sale and I want to save my house. I bought the money book. I guess I don't really know what the question is there.
I can sum a couple things up. Thank you for your service, number one.
Yes, first.
Number two, you're in Winter Springs. I'm in Winter Garden. That's cool. Go Brady. I was happy about that to a certain extent. I grew up in Missouri a little bit, so I kind of had to go against my team. So you're in cybersecurity, so that tells me you're probably enrolled at University of Central Florida. They have the #1 cybersecurity school in the nation. So you haven't paid your mortgage. You're coming up into forbearance. So here's what's going to happen with this. And I get asked this all the time. So there's going to be multiple different solutions for this. Solution one is oh, you know what, Kevin, sorry about this, Kevin. You haven't made payments in 12 months. The forbearance period has been lifted on your mortgage. You owe it all to us now. That's not a good scenario. Scenario two is, hey, no problem, Kevin, understand, you didn't work. You're 12 months behind. We're going to just, we're going to refinance the loan. What's that? You haven't been working for 12 months? Oh, you're not going to qualify for that, right? So there's two avenues right there that aren't good for you. There are going to be some mortgage companies that are going to take that forbearance period, that 12 months, and roll it to the back end, which I find very strange, Chris, because in a mortgage, they're getting their principal up front. So I'm not sure how they're going to work that, what the workaround is, but I'm sure they know, right? Because I'm just going to tell you this, it's not to our benefit, but they figured it out. So that's the answer to the question, Kevin. You need to work with your mortgage company. You need to find out if they're A, B, or C on the options there, and what you have to do to hang on to that house. There could be other situations where, rehabbers may want to fix the house up, buy it, let you live there as a rental for a while. I mean, it's no fun to lose a house, but at the same time, there's going to be different opportunities that come up to you that may make an option that you're not willing to accept right now, but it may be the best one for you.
Great advice. as a Canadian with a corporation, can I buy U.S. properties in U.S. LLCs?
No, the answer is yes. Should you? No, because LLCs are not recognized in Canada once again. So you're going to hurt yourself from a tax perspective. So you're going to have to buy it in a corporation.
All right. Have you heard of Valcorp, VEIL, Valcorp? How is it different from NCH? And she started with them.
I have no idea. I don't know who it is. There's a lot of companies out there, guys, good, bad, or indifferent. Let me just remind you, we've been around for 31 years. I promise you they haven't, or I would have known who they were.
Yeah. And then Candy said, for clarity, and this is just a clarity question for self-employed businesses. Wait, yeah. For self-employed businesses are taxed 15.3% plus ordinary income on your business income.
Yeah. So how that works, the self-employment tax, the rate is 15.3%, right? So your W-2 component is going to pay 15.3% plus ordinary income tax at the end of the year. So that's whatever tax bracket you're in. You're not taxed twice. It's just in two separate components.
Awesome. We actually got all the questions done.
Oh, Cynthia Aiken says, thank you, thank you, thank you. But now my brain hurts. Job accomplished.
There you go. There you go. Yeah, that was phenomenal. You're just a wealth of knowledge, man. Like I sat there, I was trying to answer questions, so I missed a lot of the stuff I really wanted to write down, but it was great. I'll just text in and get that deduction thing. But yeah, you guys are just on top of stuff, man.
Well, this is a, unprecedented times for everybody. So we have to watch every dollar. And if we're losing, hemorrhaging out money tax-wise and we don't know it, we're going to keep repeating those same mistakes. So it's great that you offer these forms to your students, your investors. Hear nothing but great things from them about you. And I've known you for a while now, and I follow you all the time. I was watching you and Steve yesterday. So I learned a lot of things. I've got notes here, don't let your excuses turn into regrets. We're all running out of time to be who we want to be, So I appreciate the time, Chris. It's been valuable for me as well.
I appreciate you coming on and helping everybody kind of learn a little bit about this. The tax strategies and the different tax changes that are going on right now are crazy times.
Cross our fingers and hope they don't happen.
Yeah, well, let's hope so, but let's plan for them happening and get ahead of it. That's the most important thing. So thank you for your time. And every one of you, thank you so much for joining us for another week of the Wealth Webinar Series. Join us next week. But before you do that, join us in a few hours from now at 4:30 Eastern time for our happy hour, which is nothing more than an Ask Me Anything. You come on and we'll have a whole panel of people just ready to answer your questions. So please join us at 4:30. And with that being said, anybody that has questions that are still remaining, click and register for the AMA. I'll put it up one last time and you guys can ask all your questions then, because we are just going way over and I don't want this recording to be too much longer than this. So with that being said, folks, thank you so much for your time. You guys, as always, are part of the 5% club. The other 95%, they're not here. So we'll see you at 4:30. And if you can't make that, I'll see you next week. Thanks, everybody.
There you go.